Taxes on commodities and services are levied on transaction value of goods and services. As per the state list of the Constitution, the important taxes assigned to the states include sales tax, state excise duty, motor vehicles tax, passengers and goods tax, electricity duty, and entertainment tax. All these taxes contribute approximately 85% of the state's own tax revenue. Sales tax has its evolution in India dating back to the Kautilya's Arthashastra. In the present century, the Indian states were empowered to impose sales tax through the Government of India Act 1935. The first state to resort to a general sales tax was Tamil Nadu, introducing a multi-point sales tax in 1939. Following Tamil Nadu, many states resorted to this form of taxation. The Indian Constitution provided the authority to states via entry 54 of the state list to levy the tax on the sale or purchase of goods other than newspapers, subject to the provisions of entry 92A of list 1. However, the authority to levy tax on interstate transactions was given to the central government by entry 92A of the union list. Drawing the powers from the union list, Parliament enacted the Central Sales Tax Act 1956 to enable central government to levy tax on the sale or purchase of goods other than newspapers in the interstate trade. Thus, the sales tax has two components: state sales tax and central sales tax. The state government levy and collect sales tax on intra-state transactions, whereas the central government levies central tax on goods sold in interstate trade, but the tax is collected and retained by the states. The sales tax has been in vogue in Indian states for over 60 years now. Most of the states have levied sales tax at first point, that is, tax is levied on first transaction. For example, manufacturer to wholesaler. Efforts have been made in recent years to replace this by a value added tax, normally known as VAT, as the sales tax system had some inherent weaknesses. The first and the foremost deficiency relates to its cascading effect as it is levied at first point. Second, the existing system results in uncontrolled incidence of the tax. The total effective incidence on a commodity at the end of the chain of production distribution process was enormous. Also, it had a problem of multiplicity of rates. Multiple rates make tax structure very complex and increases administrative and compliance costs. Heterogeneity also prevailed in the structure of tax by having entry tax, luxury tax, etc. Fourth, economic consequences of widespread taxation of input leads to vertical integration of firms to avoid tax. Lastly, sales tax system lacks neutrality. It interferes with the producer's choice of inputs and outputs and thus creates economic distortion. The tax was levied in erstwhile province of Madras, which included the present state of Tamil Nadu and parts of many of the present southern states. The cost in collection of tax by the department is known as administrative cost, and the compliance cost refers to the cost borne by the taxpayer.
After studying this module, you shall be able to define the budget of the Union government, understand the structure of the Union government budget, and the structure of the revenues of the Union government. First of all, let us define Union budget. The Union budget is a comprehensive display of the government's finances. It is the most extensive account of the government's finances in which revenues from all sources and expenses of all activities undertaken are aggregated. This annual financial statement shows the receipts and payments of government under the three parts in which government accounts are kept. First, Consolidated Fund under Article 266. All revenues received by the government, the loans raised by it, and receipts from recoveries of loans granted by it form the Consolidated Fund. All expenditures of the government are incurred from the Consolidated Fund, and no amount can be withdrawn from the fund without authorization from Parliament. Second, Contingency Fund under Article 267. This is the fund which the government uses in emergencies to meet urgent, unforeseen expenditures which can't wait for authorization by the Parliament. The government subsequently obtains parliamentary approval for such expenditure and for the withdrawal of an equivalent amount from the Consolidated Fund. The amount spent from the contingency fund is recouped to the fund. Third, public account under Article 266. All money in this fund belongs to others, such as the Public Provident Fund. The government merely works as a banker in respect to this fund. The budget system was introduced in India on 7th of April 1860, when the importance of financial policy for the country was emphasized. The first general budget of India was presented by the India's first finance minister, Sir R. K. Shanmugam Chetty, on November 26, 1947. Since then, 23 Union finance ministers have presented the budget every year. The 2013 to 14 budget is the 82nd Union budget of India from the year 1947, including 66 regular or normal annual budgets, 12 interim budgets, and 4 special occasion budgetary proposals or mini budgets. The annual India budget has to be passed by the House of the Parliament before it can come into effect on April 1st, the start of the India's financial year. Let us first understand the structure of the Union budget, that is primarily made up of the revenue budget and the capital budget. Revenue budget shows the revenue receipts and expenditure of the government who is required to perform various duties and functions. On the other hand, capital budget primarily comprises of capital receipts and capital expenditures of the government. All those receipts of the government which are non-redeemable are termed as revenue receipts. These receipts are divided into two heads: tax revenues and non-tax revenues. The tax revenues consist of direct taxes and indirect taxes. Greater attention has to be paid to raise funds through non-tax revenues because of the limitations of raising revenue through taxes. Since non-tax revenues broaden the source of revenue, they are vital in meeting the growing fiscal deficit and funding infrastructure investments. Let us first discuss tax revenue. Taxes are the first and foremost source of public revenues. The major share of revenue receipts of the central government comes from taxes. The following are the characteristics of a tax. A tax is a compulsory payment made to the government. People on whom a tax is imposed must pay the tax. Refusal to pay the tax is a punishable offense. There is no quid pro quo between a taxpayer and public authorities. This means that the taxpayer cannot claim any specific benefit in return for the payment of a tax. Every tax involves some sacrifice on the part of the taxpayer. A tax is not levied as a fine or penalty for breaking law. The major objectives of taxation in the context of India are: first, to raise sufficient revenue to finance public sector projects without severely affecting savings and investments of the private sector. Second, to spread the tax burden equitably across different sections of society in order to reduce income and wealth disparities. Third, to restrain conspicuous consumption by affluent sections of society. Fourth, to divert investment from luxury goods industries to labor intensive and essential goods industries. Fifth, to mop up excess profits. Direct taxes are imposed on the income and wealth of individuals or organizations. The most common types of direct taxes in India are: personal income tax. Personal income tax is levied on the total income of private individuals after some permissible deductions. In India, personal income tax is paid to the central government. Corporation tax. This tax is levied on the incomes of registered companies or corporations in the country, whether national or multinational or foreign. Since a company is given a legal status, corporate tax is a direct tax. Property tax. For income tax purposes in India, property is considered as a source of income. Therefore, tax is levied on the income from property. Properties usually include buildings, flats, shops, and land, etc. Capital gains tax. Profits generated from the sale of a capital asset are taxable as capital gains. The tax is applicable in the year in which the sale of the capital asset takes place. Capital assets are all types of assets, that is, movable or immovable, like business stocks, paintings, jewelry, and ornaments, houses to family businesses, farmhouses, etc. Indirect taxes are imposed on commodities and services. The impact and incidence of indirect taxes falls on different entities. The person on whom the tax is imposed bears the impact, while the person who ultimately pays it bears the incidence. To what extent the burden can be shifted depends on the degree of demand for that product. In the case of necessary products or essential commodities for which the common consumers have almost no substitute, a significant chunk of the tax can be incorporated in the final price of the product. The following are the major indirect taxes levied in India. Sales tax. A sales tax is a consumption tax charged at the time of purchase of certain goods and services. Excise duty. Excise tax, more commonly known as excise duty, is levied on the goods manufactured and consumed in India. Excise tax is based on quantity, not value, of the product purchased. It is one of the most well known forms of taxation in the country. Customs duty. Customs duty is one of the most important tariffs in India, regulated under the Customs Act of 1962. It is levied on imports and on selective exports. Service tax. Service tax was introduced in India for the first time in 1994. It extends to the whole of India except the state of Jammu and Kashmir. It is levied, collected, and appropriated by the union government. This is a tax collected from service providers.
To overcome the limitations of sales tax and to reform the commodity tax system, the Government of India took the initiative to design an acceptable structure for VAT. This was accompanied by a study report titled Reforms of Domestic Trade Taxes in India in 1994. The Government of India sought comments on the study report from all the states, and subsequently a conference of the chief ministers and finance ministers of the states was convened on 24th May 1994 to discuss the report. The conference took the view that as value added tax being a new tax, a small committee of finance ministers should first review the report. Hence, a committee of 8 finance ministers of states was constituted. This committee gave its report in August 1995. The committee made some crucial recommendations. The report was discussed in the Conference of Finance Ministers held on 4th of July 1997. The conference recommended that all the states should shift to value added tax or VAT at the same time after being given sufficient preparation time for implementation of this tax, and it also suggested that a model VAT legislation should be prepared for the guidance of the states. Accordingly, a model value added tax or MODVAT law was prepared in 1998 and circulated among the states.
Non tax revenue includes all revenues other than taxes accruing to the government. These are internally generated funds. The major components of non tax revenues of the Indian government are interest receipts on loans advanced to the state governments, union territory governments, and public sector enterprises, etc. The government also gets revenue by the way of surplus in the form of dividends and profits from public enterprises. The surpluses of these enterprises are an important source of non tax revenues. A fee is charged by the public authorities for rendering a service to the citizens. Unlike tax, there is no compulsion involved in a case of fees. For example, fees are charged for issuing of passports, driving licenses, etc. Fines or penalties are imposed as a form of punishment for breach of law or non fulfillment of certain conditions or for failure to observe some regulation. Special assessment of betterment levy is a kind of special charge levied on certain members of the community who are beneficiaries of certain government activities or public projects. For example, due to a public park in a locality, etc. Gifts are voluntary contributions by individuals, organizations, or foreign governments to the government. Lastly, grant from one government to another is an important source of revenue in the modern days. The government at the center provides grants to state governments, and the state governments provide grants to the local governments to carry out their functions.
Under sales tax regime, all the states have given huge concessions to attract new industries. To review all such incentives, a small committee of chief ministers was set up under the chairmanship of Shri Jyoti Basu, the then chief minister of West Bengal, which submitted its report in 1999. The recommendations of the committee of chief ministers and finance ministers were as follows. The number of rates prevailing under sales tax be reduced to a 4-rate structure. The number of exemptions under sales tax be curtailed considerably. No new tax exemptions known as incentives be given to the industries, and the existing incentives be converted into deferment, and the value added tax should replace the existing sales tax system. It was resolved at the conference that all the states and the union territories should implement uniform floor rates with effect from 1st January 2000, and the value added tax from 1st April 2001. Also, it was decided that the interim period would be used for preparation, training, computerization, and publicity. However, some problems are faced in the implementation of the above recommendations. First, there were states that did not have sales tax, for example, Arunachal Pradesh and Mizoram. It was recommended that these two states must introduce value added tax by enacting a suitable legislation so as to fall in line with the rest of the country. The second problem was related to the states, union territories, which have not complied with the decisions to have a uniform floor rates. The Standing Committee recommended that the states and union territories, if not introducing value added tax, 25% of their financial assistance that was provided to them by the Government of India be withheld with immediate effect. Also, it was suggested that a team of empowered committee visits these states and union territories to convince them to implement the same. Thus, it was felt that prior to the introduction of value added tax, states should rationalize their existing sales tax system by adopting two major reforms. The first reform related to the adoption of a four rate structure, that is 0%, 4%, 8%, and 12.5% in the existing sales tax. These rates were in addition to the two special rates of 1% and 20% for a few specified items. The recommended rates were floor rates. The states had the freedom to adopt a higher rate on any of the commodities from the list. The floor rates have checked the rate war and diversion of trade among the states. However, when the states started implementing the four rate categories, many of them found it difficult to impose it on some commodities. Either there were problems with the classification of goods or there were administrative difficulties in implementing the floor rates. The second reform pertained to the evolution of incentives related to sales tax, as all the states granted various incentives to new industries in the form of exemption from tax on the purchase of inputs, sales of finished goods, as well as sales tax loans and or tax deferrals. Various studies and committees reports have already argued against such incentives and pointed out that these incentives take the form of tax competition or war and lead to harmful tax practices in a federation. As suggested by the committee 1999, all the subnational governments have stopped giving sales tax related incentives to new industrial units. However, there still existed the concessions already granted to the existing units. After the introduction of the VAT, these incentives have been converted into a system of tax deferral or remission.
All those expenditures of the government which do not result in creation of physical or financial assets are termed as revenue expenditures. They relate to the expenditures related to the normal running of government departments and various services. Interest charged on debt incurred by the government and the grants given to the state governments and other parties. It constitutes more than 80% of the total expenditures, net of debt repayments. Major components of this are payment of salaries and pensions to the government employees, interest payments and subsidies, etc. Those receipts which create liability or reduce financial assets are called capital receipts. The main components of capital receipts are loan raised by the government from public, which are called market loans, borrowings by government from Reserve Bank and other parties through sale of treasury bills, loans received from foreign governments or bodies, and recoveries of loans granted by the central government to state and union territory governments, including other parties. Capital receipts also include the proceeds from disinvestment of government equity in public enterprises. Capital receipts could come from within India or from foreign governments and multilateral organizations like the International Monetary Fund. Those expenditures of the government which lead to the creation of physical or financial assets or reduction in recurring financial liabilities are called capital expenditures. Such expenditures pertain to acquisition of assets like buildings, machinery, equipment, and investment in shares, loans, and advances given to the state and union territory governments, public sector enterprises, and other parties.
Many states have provided some attractive incentives under sales tax to lure industries. These incentives had taken various forms and applied to different industrial units for varying periods depending upon the location of industry in backward or developed areas of the state. The concessions may be in the form of tax exemption, tax waiver, tax deferral, tax loan, and refund of sales tax. These incentives were offered generally to all new industrial units if units were established in certain identified backward regions. The quantum and scope of the incentives differed according to the area in which the industries were set up. Sometimes the incentives were offered on a selective basis. In many states, the exemptions were offered with the objective of regional development. In value-added tax regime, such incentives create problems in tax credit. Therefore, all the industrial incentives were discontinued with the introduction of the VAT, and also all other states or other taxes such as the turnover tax, surcharge, additional surcharge, and special additional tax were abolished. Let us now recapitulate what we have studied in this module. Taxes on commodities and services are levied on transaction value of goods and services. Commodity taxes assigned exclusively to the state governments are sales tax, now called state value added tax, state excise duty, motor vehicles tax, passenger and goods tax, and electricity duty and entertainment tax. Among the taxes, sales tax contributes nearly 61% of the tax revenue to the state exchequer. All these taxes taken together contribute approximately 85% of the state's own tax revenue. Sales tax has two components, that is the state sales tax and central sales tax. State sales tax is levied and collected by the state government and levied on the taxable turnover. The central government levies central sales tax on goods sold in interstate trade. The tax is collected and retained by the states. With the introduction of value added tax, the union and the states have agreed to phase out CST. Sales tax has been replaced by a system of value added tax known as the state VAT. It took almost 10 years from 1995 to 2005 to implement state VAT in all the states. VAT is a multi-point sales tax with set-off collected at each stage of production and distribution process. It provides tax credit for all taxes paid on inputs including capital goods, and therefore does not have any cascading effect. Value added tax has four rates: a standard rate of 13.5% and 5% rate on necessities. Besides, it has zero rate and 1% rate. Petroleum and petroleum products and tobacco have maximum rate of 20% and it is not under value added tax system.
Let us now summarize what we have learnt in this module. Union budget is an extensive account of government's finance in which revenues from all sources and expenses of all activities undertaken are aggregated. It comprises of revenue budget and capital budget. Revenue budget includes tax revenue and non-tax revenue. Tax revenue can be further classified as direct tax and indirect tax. Capital budget comprises of capital receipts and capital expenditure.